Hello investors, I'm Stuart Kruse and welcome to Market Mondays at Kruse Asset Management. We're just going to look at a couple of market indicators right now and just try and gather the health of the market. We know unemployment's very high right now relative to historical figures, especially the U6 number. But let's just take some main broad-based indicators. The S&P 500, we know that's also been healthy. If we look at this chart from our friends at White Charts, we have come through. This is a one-year chart. We hit a peak back February 19th, fell March 23rd. We have since broken through that top line peak and hit an all-time high, pulled back a little bit, but now it looks like we're breaching this next all-time high. Big question is, if we don't hit that top and we start to sell off, that would constitute a double top, and that's not actually technically very good for the market right now. But we'll see what happens because we're on an upswing for sure, no question about it. So we're going to be anxiously waiting to see how that thing moved. If we look at a percentage, we're up 18% year to date. After 1 year, year to date, we're up 9%. So let's look at oil prices. Brent crude oil prices, $39 a barrel, down from a peak of year to date, it was at 70. So we're looking at a decline of 41% in oil prices. That tends to be very good for the stock market because production ends up being about 50% of cost of goods sold. So when you have energy at a discounted price, then that makes everything cheaper to produce and generally gives more goods and services at a lower cost. And so that spurs economic development. So they say the cure for low oil prices is low oil prices. And that's what we have. And when we have oil prices that are below what they were 6 months ago, let's go to a 6-month chart. 6 months to a year ago. The 6-month chart, this is an interesting chart because we're well off of our lows. We hit a kind of an anomalic kind of place where oil fell down to, in some cases, the futures were actually negative, but the general trend of oil has been lower. So when you see oil lower over time, that tends to lead towards economic development 6 months from that period of time. So that bodes good for the economy. Let's look at gold right now. Gold, here we are, has been an upward trend for last year. It's doing well, but if you can see, up, and then higher high, and then lower high, lower high, lower high, lower high. So that is indicative of a shorter term market reversal. So you're looking at gold kind of selling off a little bit, but no question about it, for the last 12 months, normalized up 28%. That's a great number, 26% year to date. But if we're really looking more short term, only up 6%. And if we come into the 1 month range, we're actually negative. So gold looks like it might be reversing. That's probably a signal that the fear of the marketplace is reducing, which is surprising to me, but maybe it's just a indication that people are getting much more used to having the coronavirus as being part of the lexicon of their life. So let's look at real estate right now. Here we have real estate on the 3-month period. Let's look at year to date, down 17%, but you can see this has fallen off during the lockdown and trended back up and leveled off. So now I think the market's trying to find its footing. Do we stay home? Do we work from the office? Do we need more office space because we need more space, or do we need less office space because fewer people are working from at the office and working from home? I think that's going to be played out. You see a big disparity in real estate REITs. Like the industrial REITs are doing amazing, where the shopping mall REITs are getting crushed. It's just what you might expect. I don't see a reason why that trend wouldn't continue, but there we have REITs down 17% year to date, and a 1-year chart also down 17%. And now let's go to, let's look at the 10-year Treasury. 10-year Treasury was up in this, coming up on 1.75% earlier in the 12-month period at the end of 2019, then had a steep sell-off during the coronavirus lockdown, and has trended pretty low, hit a very low spot of basically 50 basis points, and now has recently kind of rallied up to about 80 basis points. So the question is, are we going to start seeing some of this expected inflation? If we do, or expected multiple creep up, or return interest rate creep up, if we do see some of that, you might see multiple compression, which would affect a lot of these tech stocks that are trading at a high multiple. So this would be the first sign. If the 10-year Treasury, let's say, breaks this number at 91 basis points, I would really start to be concerned about having some high flyers in your technology company, maybe getting out some of those names if you're overly weighted there. So let's look at all these companies or all these economic indicators on a normalized basis, like a percentage change. So the 10-year rate has changed 55% down. We're going to add REITs and gold and crude oil. Excuse me. So here we have on a percentage change. Right now, gold is up after 1 year. And let's maybe go to year to date. That's a little bit more fun. Gold's still up 26%. We know the S&P has had a good year so far. REITs down 17%, as we mentioned. Brent oil down 41%, and the Treasury down. So these things are looking like weak economic indicators, but the oil would suggest 6 months from now we should be doing much better. REITs are still trying to find their footing, and then traditionally the stock market is a look-ahead vehicle, so suggesting that we're doing pretty well bodes pretty well for 6 months ahead from now. So there we are. This is Market Mondays at Kruse Asset Management. This is Stuart Kruse reminding you to invest with the odds in your favor.